successor, Brad Corson. Brad took over from Rich Kruger in January, and like Rich, came over from Exxon, where he started his career in 1983. Brad, I'm looking forward to hearing from you today, since you only had about 6 weeks in the seat before things started to go sideways in the oil market. So maybe you could just take the first few minutes to describe what it's been like to transition into a key leadership role during the most volatile period the industry has probably ever seen. And as a part of that, maybe you can just walk us through your key messaging at this time, and then we'll dig into the Q&A.
All right. Well, good morning, Menno, and good morning, everyone else. It's certainly my pleasure to speak with you today. I wish this was in person, but obviously I think everybody's adapting as best they can with these sort of virtual discussions, which I've been doing a lot of, as I'm sure you have as well. You know, in terms of my first few months here, no doubt a very challenging time to step into the chairman, president, CEO role. Certainly has far exceeded my expectations for the challenges. I knew it would be challenging, but I don't think any of us could foresee these difficulties. Having said that, though, I would just say I am very pleased and proud of the Imperial organization. I think through this challenging time, we have been able to demonstrate you know, the fundamental strengths of the company, the resilience of the organization, and the adaptability of the organization. And so, you know, I feel quite good on a relative basis for where we are right now. You know, we entered the year in a strong financial position with a significant amount of cash available to us, as well as low debt levels. In addition, you know, we had just completed some very important projects at Kearl, namely the supplemental crushers, which allowed us to demonstrate some very strong operational performance in the first quarter. And likewise, in the downstream, we also had some upgrades at our Strathcona refinery, which also allowed Strathcona to deliver some very strong operational performance in the first quarter. So when you couple that, you know, with kind of the strength of our financial position, it's allowed us to weather this very difficult time, you know, I think as well, if not better, than most in our space. I would also highlight, you know, from a health standpoint, we've continued to keep the health and safety of our workforce, both employees and contractors, as our number one priority. We did have, unfortunately, several cases of COVID at our Kearl camp. But again, I'm very proud of how the team managed through that difficult time. And as many will have seen, you know, we were kind of named as an outbreak site by the Alberta Health Services. We worked very closely with them in a very positive way to help address that situation. And as of 4 weeks ago, the Alberta Health Services declared that the outbreak is over. We currently have no active cases on site, so I'm quite pleased that we could manage through that. And so, you know, kind of summing up, I would just say I'm very confident with the company's position. We've started to see improvements in the market and the underlying fundamentals over the last month, and I think we're well positioned to capitalize on the market as it continues to improve through the remainder of the year. And then as we look a little bit further long stream, we've got some good growth projects in our portfolio. We've got some really important strategies that we're implementing around cost performance as well as environmental improvements, and I think that those will also position us very well for the longer term. I'll leave it with that.
Terrific. And so maybe just to touch on budgeting, you cut $500 million out of the 2020 budget through adjustments to the pacing of work. Can you just maybe remind us of where the cuts were made? Does $500 million still feel like the right number given the big uptick in strip pricing? Is it likely that we see CapEx creep higher? And then maybe to pull all of that together, just to the extent that the strip holds, can you directionally walk us through what the profile for each of your key upstream and downstream assets could look like through the end of the year?
Yeah, I mean, in terms of CapEx, obviously, when we took those decisions late in the first quarter, as we were assessing the market, both from supply-demand fundamentals and the impact that would have on economics, but also the severe impacts of COVID and how that was likely to impact our ability to execute work. And so through that assessment, we felt it was appropriate to reduce our capital budget from a prior target of $1.6 to $1.7 billion for the year, reduced at $500 million, as you noted, such that our current target is $1.1 to $1.2 billion. So that represented a 30% reduction, so quite material. And in terms of where those reductions were targeted, it was really across all of our assets, both upstream and downstream. And it was primarily associated with the pacing of work execution. So, for the most part, I would say all the projects that we had in the budget not only were economic, at the time we developed those plans, but they continue to be economic as we look to the long term. And so, we have not canceled any projects per se, but instead just repaced them, and again, reflective of the COVID impacts and how many people we can have on site at any one time to maintain safe distancing and other health considerations. So, as the COVID situation improves, then the pace of our execution will increase as well. As I sit here today, I look at kind of where we are. The teams continue to give me and the management team updates on their outlooks for the rest of the year. That 1.1 to 1.2 range still seems pretty realistic for us. But assuming that we see continued strengthening of the economic fundamentals, but also the health environment and our ability to execute work safely, I think it's conceivable that we will see higher levels of spending for next year, but we have yet to finalize what those targets would look like. We're in our kind of annual budgeting. Will be over the next couple of months for next year. And so certainly by the time we get to our investor day in November, I'll be in a position to describe what 2020 will look like. But for 2020, I think it's safe to assume we'll stay in that 1.1 to 1.2 range. And then kind of expanding into the second part of your question is, kind of what does the profile of the assets look like for the rest of the year? Obviously it is very dependent on the economic outlook, the supply-demand fundamentals. But if we continue on the path we're on, I feel quite optimistic. We purposely accelerated most of our turnaround activities into the second quarter, and a majority of those are completed now or nearing completion. And so when we get to the second half of the year, for assets like Kearl and Cold Lake, and certainly our downstream refining assets at Sarnia, Nanticoke, and Strathcona, we expect to be able to operate with limited interruption of those assets, and so would be back on track, to certainly full production levels in the upstream assets. The downstream assets will still be somewhat dependent on demand for our products, but we are seeing continued improvement in demand for motor gasoline especially, but also some improvements for diesel and jet to a lesser degree. But our outlook would suggest those demand utilization will continue to improve through the remainder of the year. And so again, by having the turnarounds behind us, we'll be able to take full advantage of that.
So I'm going to put you on the spot a little bit. Yeah, no, that was really thorough, Brad. I appreciate that. So we hosted Suncor in one of the prior panels, and Mark suggested that he believed that downstream would lead the recovery, or refining would lead the recovery, and it's a bit of a contrarian view. Are you in that camp as well?
Well, I didn't have the benefit of hearing Mark's comments.
Yeah.
I'm not quite sure exactly what he means in that regard, but I guess building on my prior comments, we are seeing continued strengthening of demand in the refining sector, especially motor gasoline, like I said, and diesel. It has not been as strong in jet yet. We're still at probably 70% below where we would be historically for jet. So we're keen to see that situation improve. But by and large, we are seeing refining strengthen, and obviously that sends very positive signals to the crude market, which underpins our ability to economically produce from our upstream assets. But for us, those two go hand in hand, and so we project both strong performance in the second half of the year for the upstream as well as the downstream.
Okay, and then if we flip over to Line 5, it's clearly been very topical for both yourselves and Suncor. How much of your, how reliant are you on Line 5 when it comes to Sarnia, and what other options could you have when it comes to sourcing alternative sources of feedstock?
Yeah, it's a really good question, and obviously something we've been focused on quite carefully over the last week or so, as Line 5 was first shut down, and then was allowed to restart at least one of the two parallel lines, earlier last week. And so, for us, Line 5 is integral to our crude supply network to feed both Sarnia and Nanticoke refineries. We do get a large percentage of crude through that line. Fortunately, we're not solely dependent on that line, though. We have other pipeline access available to us. We do have rail offloading at one of our 2 refineries in Ontario, so that gives us additional flexibility, and we can also take waterborne cargoes. So, the team worked quite proactively over the last couple of weeks to make sure that we had adequate contingency plans in place. Should Line 5 be interrupted for an extended period of time. And so, we were prepared for that and would be prepared even for a longer outage, although we're quite pleased that it's back in service, and we hope it'll stay in service.
And if we flip over to shareholder capital returns, I mean, that was something that we talked about ad nauseum about 6 months ago, and then it went away a little bit. But you recently announced that you would be restarting your NCIB with a limited scope. So the question is, at what oil price do shareholder capital returns realistically become a bigger part of the conversation? And then how are you prioritizing dividend increases, which typically coincide with Q1 results, but not this year for obvious reasons, and share buybacks?
Yeah, let me start with share buybacks just to clarify one point. We suspended our share buyback program earlier this year, as part of our kind of financial strategy to ensure the strength of our balance sheet, through this difficult period in time. And at the time we suspended it, we were on pace to buy back 5% of our shares, which was the maximum allowed. And so that's the program we suspended. You're correct in that we have reinstituted it, but I would just clarify that what's been reinstituted is a very nominal, a very low level of share buybacks, really just to adjust dilution that would occur in the normal course of business as a result of kind of employee incentive programs where they're allowed to retain shares versus cash. And so it's very small. I think the number is like 50,000 shares or something. It's quite minor. So not the big program we had before. So for all practical purposes, the share buyback program is mostly suspended still. And so our capital allocation strategy, focuses first on ensuring we have enough capital or funds available for our sustaining capital requirements in the business, which we normally say are around $1 billion. So we first need that to ensure the health of the assets. And then beyond that, we will be looking at investing in future growth opportunities as well as returning cash to shareholders. As you said, we have a long history of paying a dividend to our shareholders, over 100 years, in fact. And of those last 100 years, in the last 25, we've raised a dividend every year. Often that dividend increase is announced at the end of the first quarter. We obviously did not announce an increase this year. We did not think that was prudent. But we did think it was prudent to maintain our dividend. And so, we will routinely reevaluate that decision. That is a common review item for the board. And so, the coming quarter is no different in that regard. I don't want to kind of signal, kind of what that decision will be. That would be premature. But I would say that, we continue to believe we're in a strong financial position and certainly place a high priority on maintaining that dividend. So I'm optimistic in that regard. And then in terms of when we will, further, if you will, reinstitute the share buyback, versus other options we have to return cash to shareholders or invest in growth projects, we'll be taking those decisions on a quarter-by-quarter basis. We do have a strong portfolio of growth opportunities. Obviously, we need to weigh those against the current economic environment, but we continue to look at those quite carefully.
Fantastic. Thanks a lot, Brad. Really appreciate your time.